Hi folks, welcome to this short video on preparing a pension worksheet for a company that follows ASPE or Accounting Standards for Private Enterprise Standards. And we're talking here in this question about using the immediate recognition approach. The purpose of the worksheet primarily is to help you calculate the amount of pension expense and to see how that expense that you're going to record during the year as a company is going to affect other accounts, whether those accounts are on your books or not. So in this question, we have a lot of elements to consider, but before we do that, it might be worthwhile to go back and have a look at the actual formula that we use to calculate pension expense for under immediate recognition for companies that follow ASPE standards. So in order to calculate pension expense, we're going to need to find out the current service cost. I've just shortened that to say CSC, current service cost. So employees who are working for us this year, how much more value have they contributed to their plan, or how much more from a company perspective is the obligation that we're going to have to set aside to pay them a pension because they've worked an extra year and they're a year closer to retiring, right? There's also interest costs that we have to calculate as well. And interest accumulates on any debt you have. Well, the amount of debt that a company would have would be the value of the accrued benefit obligation plus any past service costs that they might have at the beginning of the year. So the interest expense is going to be calculated on the ABO, which is the accrued benefit obligation at the beginning of the year, and under ASPE, that's on the funding basis, plus any past service costs that you had at the beginning of the year. You would add those two amounts up and calculate interest cost or interest expense on it for that same year, and that would give you interest. But don't forget, you'd also have to add in your past service costs. So if there were any plan amendments that took place, right? So say, for example, the workers were going to get a bigger benefit because the company perhaps has granted them a benefit for past service, then that would be added to your pension expense. And if you had any actuarial losses during the year, don't forget actuarial losses are things like, say, for example, we expected to get returns of 8% and we only got returns of 6%. Right? Say, for example, we thought that people were going to live, the average life expectancy might have been higher than we thought. So those are things that would actually mean that we probably put less money into the plan than we thought we needed to. So maybe we need to revise our actuarial assumptions because we didn't put in enough. So those would be losses that we have to include. Or maybe we might have had some actuarial gains, which we would deduct from the pension expense. So again, if we thought our plan was going to make 8% and it made 10%, that's a gain, right? Because it made more than we thought. If we thought people were going to live to 80, maybe our average life expectancy for males was 82 and they only lived to 79, so anything that's going to create better value or a better position for our pension plan from a corporate perspective is considered a gain. And then don't forget, you also have your actual return as well, which is deducted in order to calculate pension expense. And why would we deduct it? Because these are all costs. The ones I'm clicking here are all going to be costs. And those costs would be reduced by the amount of money that your plan made, right? So that net, it would give you pension expense. So now with that in mind, we construct the worksheet with our major heading, pension expense, the amount of cash, and we're looking to put a number in here that will be given to us in the question that tells us the amount that we would have contributed to fund the plan this year. The net defined benefit liability or asset, so this is an account also on our books. So these first three accounts would be accounts that are on our books. The expense is on the income statement, and it's the amount that we would have to expense for the year. The amount of cash would be what we'd contribute to the plan this year. And the net defined benefit asset or liability would give us the amount that we're over or underfunded during the year. If we're underfunded, which is the difference between the ABO and the plan assets, and you can see the liability for pensions to pay retirees. The obligation we have to pay our retirees is $280,000, but we don't have enough dough. We only got $273,100 in the plan. Well, not everybody's going to retire at the same time, right? And don't forget, retirees die, so we're not paying them all. But the idea is that we have a net liability here to open the period because we have an ABO that exceeds plan assets. So our plan's underfunded, so we're in a liability position. Now, what's impacted our pension expense this year? Well, moving forward into 2013, we also had a plan amendment which gave a bigger benefit to our retirees. Okay, it might be current retirees, but it might be people retiring in future, probably more the latter, but the idea is they're going to get a bigger benefit. So we're going to include that cost this year in pension expense, and we're also going to increase our accrued benefit obligation. Now, before we go on, I just want to mention one thing. These two accounts here, the ABO, the accrued benefit obligation, and the plan assets, are not accounts that are on our books. They're not in our financial records. They're not capitalized, in other words. So in Canada, we use a non-capitalization approach. So these accounts are managed by our plan administrator. So whoever's looking after the funds in our pension plan, whoever our plan administrator is, might be a bank or another kind of a company, right? They're monitoring those plans. These three accounts here, the expense, the cash, and the net defined benefit liability or asset, those accounts are our accounts in our books. So the balances in these accounts, we don't have access to them. We don't have access to these two accounts. They're on a separate set of books. But every time we recognize that we have an obligation under expense, you see in this particular case with our past service cost, it's going to create a bigger obligation because in the future, that's the value of the past service cost now. But in the future, we're going to have to make sure that we pay out to future retirees whatever that bigger benefit is going to be. So it's a liability that we'll have for the future. Right? Now we also have current service costs, and we're debiting the expense because whenever we have a past service cost or a current service cost, it's going to increase our expense. Why? Because the current service cost is the fact that people now worked a year for us. So throughout 2013, people worked for us. So if they worked for us, that meant that they're a year closer to retiring. Now, they may not retire from us, but we don't know if they will or they won't. But the fact of the matter is, we now owe them, or we now have increased our obligation to provide them a bigger benefit when they retire because they accrue entitlement to retirement benefits through service, right? And their service is just increased during the year. So the value of that expense, or we're going to have to increase expense by $29,000, and that's also going to increase the ABO on the plan administrator's books by $29,000. Now don't forget, we also have interest cost, and we said earlier that interest cost is part of your pension expense. So now if we go back to the worksheet, we have to calculate it, and it's calculated on the ABO to open the period plus any past service costs that existed at the beginning of the year. And in our case, we had $50,000. So we're going to calculate the interest cost in the ABO and the past service cost. So I've got a little number 1 here. So if you go down here, you can see I've calculated the interest cost on the ABO at the beginning of the year, any past service cost that we were granting at the beginning of the year, add them together and multiply that by 9%. And that's going to give you $29,700. And that's also going to increase your ABO on the plan administrator books. Now, when you, as the company, make contributions to the plan, you take it out of your own cash, and what happens? It goes into the plan assets. So that's one way that your plan assets increase. They increase by you, the company, making contributions to try and fund the plan based on the costs that are going in. Now the plan made money. The plan made money of $26,140. That was the return that it made. So that also remains in the plan, right? It's just like if you get interest on your bank account, it goes into your bank account, right? Well, when our plan makes money, it goes into the plan assets. So now maybe you're starting to see why these two amounts, the ABO and the plan assets, are not kept in the company's books. Because in Canada, we don't want corporations tapping into those assets and using them for purposes other than pensions, right? So we keep them separate from the company. So again, all the returns will go directly in there and are not accessible to be used by the company for any other purpose but to pay pensions. And don't forget, during the year we have people retiring, so we would pay benefits. And during the year we have a small plan. We paid out $20,000 in benefits, but notice it's not coming from cash, it's coming from the plan assets. That's what the company is funding. Don't forget, all the contributions that go into the company's pension plan, right, or all the contributions you make go into the plan. So it makes sense that when retirees are getting payments, they come out of the plan. Right? They should come out of the plan assets, and it also reduces your obligation to the retirees. So now with that in mind, let's add up all these debits here as well as the credit, right? Because the credit, the actual return, if you'll remember, any actual returns reduce minus the actual returns to get the pension expense, right? So therefore what happens is now we can add up these four numbers here and get a net debit to our pension expense of $82,560. And when we make the expense entry, we're also going to credit the account that's on our books, which increases the liability, the net defined benefit liability / asset. We credit it for a liability. If it was an asset, then we would debit it, right? But in this case, we're going to credit it because we've got an expense to make, right? Expense to record, I should say. Now, we also have a contribution to make to the plan. We said that we were going to make contributions during the year, but now we'd make the entry to credit our cash and to debit the net defined benefit liability / asset account because we're reducing our obligation when we make payment, right? So now I just want to focus here to show you what the entries would look like. So now when we're making the entries, the expense entry here in this line, right, would be to debit the pension expense and credit the net defined benefit liability asset by $82,560. The contribution entry here to make contributions to the plan would credit our cash and debit our account net defined benefit liability / asset. Remember, these aren't our accounts, these two here, so we can't debit and credit those accounts. We acknowledge these. I kind of keep them up here and refer to them as memo accounts. I can't touch them, I can't debit or credit them, but at least at the end of the year, if I'm looking at reports that our pension plan administrator is giving us, I would have a pretty good idea of what the balance should be in those accounts because I've been monitoring what should be going into them based on expenses that I know I'm incurring during the year, right? And any money that I'm paying in, right? So in other words, I can only make journal entries to accounts, these three accounts, because these are accounts that are on my books, right? So I record the entry. Okay, so that's all I'm doing. Now when I get to the end of the year, when I look at my ending balances, this should be the balance in my net defined benefit liability / asset account, and it should be a net liability balance. And what do we know? We know that the difference between the ABO, which is a credit balance, and the plan assets, which is a debit balance, because the ABO is bigger than the plan assets, it's underfunded. How much is it underfunded by? $61,960. So we know the difference between the ABO and the plan assets should give us the amount by which the plan is over or underfunded. In this case, because I'll just make a little note here, I'll just say note, plan is underfunded at year end since the ABO is greater than the plan assets. And how do we know it? Because we've got $368,700, which is our ABO, less the $306,740, which is our plan assets, and that's going to equal $61,960, which is the amount that's in our net defined benefit liability account. So what we should be doing, and what our actuary should be advising us, is to try and make up that shortfall. You don't have to make it up all in 1 year, but you should be working toward making up the shortfall, because you can see it's growing. You had a $6,900 underfunded amount, right? So you're underfunded in your plan. It's grown by just over $55,000, right? So you should be making plans to fund that. So maybe the contributions that you made into the plan aren't big enough this year. So the company has to consider now how big the contribution should be. So they need to sit down and talk to their actuary to see how much more they should fund it by. So this is an example of how the accountant can use a little worksheet, and not just the schedules that we've been talking about, like, let's reconcile from beginning to end, but a little more visual appearance in terms of a worksheet, okay, in order to get the feel for what's happening in your own accounts as well as the plan administrator accounts, these last two here. Okay, so this concludes our video on preparing a pension worksheet for a company that reports under ASPE, okay, under immediate recognition rules.